So a little introduction, background on Professor Paul Chaney. Got an accounting degree from Indiana Purdue University. He has an MBA specializing in accounting from Indiana University, and then a PhD in accounting from Indiana University. So big Indiana guy. He's the E. Bronson Ingram Professor in Accounting at Owen. Teaches many of the accounting classes here. The three-time winner of the Dean's Award for Excellence in Teaching, beloved by many students. Has many notable pieces of research, focuses earning management, auditor reputation, and accounting for M&A. He's a frequent commenter on accounting reporting in the Financial Times and CBS's Market Watch. So without further ado, I'm going to turn the floor over to Professor Paul.
Thank you, Michael. I hope everyone can hear me okay. When I was asked to do this, it was quite a daunting task because the impact on accounting has been relatively tremendous. And so I've got so much material. Let's just jump into what I'd like to talk about. First, I'd like to talk about some of the actions that the SEC has taken dealing with financial statements. The SEC has reiterated that they still want companies to be able to prepare high quality financial information. And they understand that there's going to be a lot of significant judgments that they're going to have to make to prepare those financial statements. So to help the companies, the SEC has given public entities an additional 45 days from the date to file certain reports, such as the 10K and 10Q, if certain conditions are met. And again, they have to be related to the COVID-19 for them to be able to apply that. So they want in the reports companies to discuss how COVID-19 affects their related risk. And they pose these questions such as, how does it impact the financial condition and results of operation? How does it impact their capital and financial resources? Do they anticipate impairments and have travel restrictions and border closures made a material impact on their operations? So they want companies to address these in the financial statements. They also gave a warning. They said that companies need to refrain from trading prior to the dissemination of any material non-public data related to COVID-19 as well. What is more related to financial reporting is what I have on the screen. Again, the SEC encourages companies to think in advance how they're going to address certain these things. So they may need to start planning for their financial reports earlier in the year than normal. They're also a little bit concerned about the use of non-GAAP measures to illustrate the impact of COVID-19. We know historically companies tend to report about 2 different non-GAAP metrics, but over the years this has increased that some companies report over 7 non-GAAP metrics to explain their performance. So the SEC is a little bit concerned that companies might use these non-GAAP to kind of hide things. The real impact, though, on accounting is what I have listed under item C here, because there are so many subjective judgments that are needed to complete the financial statements, especially anytime there's any measure of fair value that's needed. And this is really important when you're going to estimate impairments, because you need to estimate the cash flow recovery of these assets over time. And in this uncertain world, as we know, it's very difficult to do. And so suppose that you impair some assets under US standards, companies, and if suppose those estimates turn out not to be valid, under US GAAP, companies are not allowed to write these impairments back up if things don't turn out to be as bad as what everyone anticipated. But the real impact on accounting comes from these items at the bottom. And again, this is just a short list, leases, debt modifications or restructuring is clearly going to be an important ingredient on how companies have managed their response to COVID-19. Revenue recognition rules have recently come into play. And so there's some concern about how companies are going to be recognizing revenues during this period. Clearly, going concern issues are going to come to the forefront. We'll talk a little bit about this on a coming slide. Subsequent events. For accounting purposes, after the year-end closes, but before companies release their financial statements, things might happen, such as the pandemic. And so the question is, how is this going to be reflected in the financial statements? For companies that had year ends as of December, most likely that's a subsequent event that would be disclosed. But if any company that has a year end that starts probably anytime from March through June or July, these are going to be an event that may require adjustments to the financial statements. The real concern about COVID-19 that a lot of people have been talking about is that earnings management tends to be revealed in times of economic crisis. During a good economic growth, people just don't pay as much attention to the accounting as they probably should. And so things that are going on, people may not notice. But when the economy starts to turn bad, this is when it becomes apparent that some companies have been playing around with their books, especially whenever there's subjective estimates involved. Now, if you've been following the Wall Street Journal, they keep talking about if you go out swimming, you can determine who's swimming naked when the tide goes out or whatever. And so this actually comes from a Warren Buffett statement where he said, you only find out who is swimming naked when the tide goes out. And so I would add to that, it also depends on how clear the pool is that you're swimming in as well. And so people are kind of preparing themselves to find companies that are perhaps doing stuff to the books that are probably not acceptable. Now we know just within the last week, several companies have claimed, filed for bankruptcy, such as Hertz. And I suspect that this is going to really increase the number of firms that are going to declare bankruptcy over the next 3 months or so. So I collected some data just to look at what the performance of companies have been over the last 3 years, and this is prior to the pandemic. And if you look at the total number of firms that filed with the SEC, 42% of these firms, or roughly around 2,300 firms a year, reported a loss on their income statement. This is prior to the pandemic even happening. Also, firms have been increasing the amount of debt that they have on the books. The median debt to asset ratio is around 28%, yet the 75th percentile is around 48%, and the 90th percentile is 74%. And as I say at the bottom, it gets worse because those firms with above median levels of debt, 44% of those firms are reporting losses. And so it doubly affects it. So I've prepared some graphs just to kind of look at. So first, if you look at the last 3 years and just look at the size of the firms, most of the focus on firms tend to be on the firms at the largest decile. So if you look at the 9th and 10th decile over on the right side of the graph over here, you'll see that the market is dominated by a few very large firms. Most of the firms that are out there are relatively small. And so I also plotted the number of employees that are listed as well. Now, while the focus tends to be on these really large companies, on this next graph, what I did is this blue graph at the bottom, that's the return on asset by those size deciles. So you can see the smaller firms down here are reporting losses. The very large firms are reporting profits. If you look at the red line here, this is the percentage of firms in each of those deciles that reported a loss. And you can see the smaller the firm is, the more likely it is that it would report a loss. The green line represents a debt to asset ratio. And the dotted line is the percent of, is where the median debt to equity is for that size decile. So as we can see, there were a lot of firms that were in significant financial difficulty prior to the pandemic even happening. Another way that you can look at the data is to look at the amount of cash that they have on the balance sheet, relative to the cash that they generate from operating activities to assets. And in this graph, you can see, again, the very largest firms over here on the right tend to generate more cash from operations than they're carrying, but these firms down at the bottom, they're generating negative cash from operations, but they're maintaining high amounts of cash on the balance sheet, and pretty much that's the only way that they can survive. But once they burn through that cash, they're going to be in severe difficulty. The last thing I wanted to plot is just the blue line is the net income to assets, and the red line is cash from operation to assets. And as, again, by size decile, the larger firms doing okay. The smaller firms on size are struggling before the pandemic even hit. So if you're trying to forecast which companies are going to be struggling, it's not going to be too difficult to identify who they are. Now, I'd like to briefly talk on the impact on auditors, the companies themselves, and then look at some footnote disclosures. For the auditors, their biggest concern is going to be, how are they going to determine whether the firm should be given a going concern opinion? And again, the forward-looking period is 1 year from the date of the financial statement. So they're supposed to look out and say, is it likely that this company is going to survive for the next 1 year? And so given the huge amount of uncertainty that's going on, this is going to be a very difficult task. Now, the auditors were criticized significantly during the financial crisis in 2007, 2008, because they didn't issue very many going concern opinions, because they figured, well, the government's going to bail out the banks anyways, and so they didn't really issue very many going concern opinions. And so that is somewhat of a concern in this market as well. Other impacts on auditors, scope limitations. It's, auditors rely on confirmations as an important source of evidence, and they may not be able to do the same level that they're doing before. So people are predicting that perhaps there might be a lot more scope limitations in the audit reports than they've been in the past. You can read through the other things. We'll post this later. So I wanted to, companies are supposed to disclose what the risk and uncertainties, how it affects the amounts in the financial statements. FASB would love them to put specific line items in various parts of the income statement to kind of explain how COVID-19 has impacted various aspects of their financial statements. There's no current standards that would require this, and so it's kind of left up to the companies to decide how to do this. One of the interesting things that happened with the CARE Act that Congress passed in March of 27 is that they provided a lot of tax relief in certain ways for companies. Probably the most significant one for companies is they changed the net operating loss rules. Now, when they passed the Tax Cut Act in 2017, they had eliminated any carry back of operating losses. And so the CARE Act brings these carry back rules back into play. Companies are now allowed to carry back 5 years. And one of the interesting things is they allow you to go back to years 2018 and 2019 and redo the taxes for those years as well. And so for accounting purposes, the way that we account for the operating loss carry back is that would actually reduce the amount of the loss that they would report in this year if they would report a loss. And so it provides a great source of funds for companies, and the accounting just makes the loss seem a little bit less than it would be. There are other tax implications too. I don't want to spend any time on that. There are a lot of technical issues related to COVID-19. We know about these rent concessions, and they're giving loan payment holidays. The government is giving low interest loans. And so the accounting for these issues can get quite complex because it really depends on the characteristics and the contracts that were already in existence at the time. If you remember back, if you took 410 in financial accounting, we know that if you have an interest rate that's below market, you're supposed to still impute an interest rate when you do the accounting for it. There's a little known rule in FASB that if the assistance comes from the government, you're not required to use a market rate interest. So you can still, even if the interest rate is way below market, you can continue to use that in terms of determining what the amount of interest expense is. So that's quite interesting. I should note that there is very little standards related to government assistance. And so companies are going to have a lot of flexibility in terms of how they record a lot of these transactions. And that's going to be very interesting to see how companies do this in the future. Now, I wanted to look at just some of the disclosures that we've seen just within the last couple months. And so Pulte Group, they acquired a company in January before the pandemic hit, and they recorded goodwill on that acquisition of $48 million. And then in March, because of significant decline in the market valuations, they went through and did a goodwill impairment test and impaired half of the goodwill from that transaction. This is very unusual in a merger and acquisition. Typically, in the year in which you make an acquisition, any goodwill that you acquire does not have to be tested for impairment in the same year that you acquired it, only if there are unusual events that happen. And so we can expect that we're going to see a lot of goodwill impairment and probably asset impairments over the next 6 months as well. Some other observed changes from looking at 10Ks and 10Qs that have been released in 2020, we see that firms are increasing cash using their lines of credit. Note that Kroger borrowed $1 billion from a revolving credit as a precautionary measure. Ultra Beauty borrowed $800 million because of COVID uncertainty, and they didn't really specify exactly how they were going to use that cash. We also know that a lot of firms are cutting their executive compensation. So I just listed 3 that I found in 8K. Cummings, 50% cut in the CEO-based pay, FedEx, 91%, and CarMax, 50% cut. So there's been a lot of reduction in executive compensation. Companies are also starting to list the COVID-19 as a risk factor. Home Depot they didn't mention it specifically. They just said there's public health issues that are affecting it. Dell specifically mentioned that it's more of a global economic condition and disruption to the global economic conditions as of the spread of coronavirus. The last thing I want to talk about, I know I'm going really fast, is we know the airlines received a lot of government support. And so I got this data from CalcBench as well. They looked at the disclosures for these 6 airlines, and they basically found that the direct cash grant given to these airlines was around 8% of their revenues. They were also given 10-year low interest loans, and these low interest loans increased their debt either 7 to 51%. The 51% was actually Southwest. Their debt actually increased quite a bit from these low interest loans. It's a little misleading because Southwest didn't have a lot of debt to begin with. Interestingly enough, when CalcBench went and read these footnotes, they said 5 of them you could really understand and exactly see how much money they were given in terms of cash grant and the characteristics of the low interest loan. But there was one airline that made it very difficult to figure out what they were actually getting and how it affected the financial statements, and that was American Airlines. And so, as I always say in class, companies have a choice. They can either make their footnotes easy to read or not, and we should take that into consideration when we read their financial statements. So I think I've taken exactly 20 minutes. I know I went relatively fast, so I think at this point I'd just like to open it up, see if anybody has any comments or questions on anything that we talked about. Is everyone still here?
I'm still here,
Hey, Larry.
Larry.
I know it was just a lot of information in a short period of time. Let me see if there were other things I wanted to say that I skipped over.
Hey, Paul, this is Mark Cohen.
Hey, Mark.
Hey, can you go back into history? You've been around like me for a while. Do you see parallels to the financial crash in 2008 or earlier? And what might you expect in terms of things like you alluded to some of the enforcement actions by SEC or even criminal actions? I mean, do you anticipate those kinds of things happening based on experience?
Well, I think the concern that I have right now is that we started these new, FASB really redid all the revenue recognition rules just a couple years ago. And these new rules require a lot more judgment and estimates involved. And so we kind of know that there's a percentage of companies that are really on the edge of profitability right now. And so the question is, how are they going to be able to survive? I mean, you need to be able to survive. You need to be able to generate some cash. And so it's not clear, what things companies can really do to manipulate that. But basically, I think what we're going to see is there probably are going to be some companies that have been abusing some of the revenue recognition rules. And so I would not be surprised if we're going to find some companies that are making themselves look a little bit better. If you go back to the WorldCom example, WorldCom had one line item that was significantly different from all their other companies in the same industry. And none of the analysts even bothered to ask them, how are they able to keep certain costs way lower than other companies in the same industry when they pretty much all had the same contracts? And it wasn't until somebody within the firm actually said, well, this number's kind of made up. And so there's always that potential problem, is that you're in an industry that might be very competitive and you're trying to do things and the mindset is always, if I can just get past this next year, things will get better. And then what happens? Then the pandemic happens, and now it's not possible for things to get better. And so I think we're going to see some companies that are going to be revealed that perhaps they weren't quite up to the level of what their reporting is. And I think that the issue with these non-GAAP is really, they take the GAAP numbers and then they redo them. And we know that the non-GAAP numbers tend to be 15% greater than what the GAAP numbers are. And so they're always in the positive direction rather than in the negative direction. And so they try to get people to look at these other metrics that it's not, sometimes it makes sense, but sometimes it doesn't make sense, I think. And so I think we're in for an interesting period in accounting over the next year, and we'll just have to see how things fall out.